The moment has come. Ethereum ETFs are about to launch, and this has everyone wondering what it could mean for ETH's price. Will it surprise us like the Bitcoin ETFs did and send ETH back above previous all-time highs? Or will it be a massive sell the news event that sends ETH crashing lower? Well, that's exactly what we are going to be exploring today. So, don't go anywhere. Before we progress, lest I forget, there is something I need to stress. There will be no financial advice today, as education and information are our only forte. Doing your own research is the only way to stay ahead in the crypto game. And with that out of the way, let's kick off with a quick overview of where we are with these ETFs. As you will recall, way back in May, the SEC made a surprising U-turn when they suddenly asked a bunch of ETF issuers to update their 19B4 forms. This sent the market into overdrive as it made them realize that the SEC was actually considering listing these ETFs, that after months of stonewalling and just limited feedback. That, of course, led to all these issuers resubmitting their 19B4 forms, which are basically rule change forms. And many of these were subsequently approved, and the issuers have since gone back and forth with the SEC in order to work on their S1 applications, which are basically the registration forms required for listing. Companies including BlackRock, Fidelity, 21 Shares, Grayscale, Bitwise, Invesco Galaxy all submitted their updated S1 applications last week, Wednesday. And there were a number of other firms that submitted their updated 19B4 forms as well. According to reporting, there are at least 10 ETFs that could start trading in the coming days. And you can see them right over here. Okay, so that's where we currently are. However, what's perhaps the biggest wild card out here is what we could see not only in terms of potential inflows into these funds, but also the impact that it could have on price. Starting off with the question around the inflows. There have been a wide range of estimates, and they range from bullish to bearish and everything in between. That's as opposed to the estimates for the Bitcoin ETFs back in December that were generally quite bullish, and even then, they still underestimated the inflows and the impact. That being said, let's start at the one end of the spectrum with the bearish scenarios that have been painted for these ETF inflows. About a month and a half ago, JP Morgan came out with a report that said that they expect the flows to be significantly underwhelming and to be nowhere near anything that was seen on the Bitcoin side. One of the reasons for this is because they think that the Bitcoin ETFs had first mover advantage and has hence already snapped up a lot of the potential demand. They also think that part of the demand for Bitcoin more recently was the halving event, a seminal moment in Bitcoin's life cycle. And they point to the fact that Ethereum's proof-of-stake consensus mechanism has no such feature, obviously. Something else that they raise, which is a concern that many people have, including us, of course, is that these ETFs are not staking ETH. In other words, by buying ETF shares, you are foregoing staking rewards that could be earned by delegating and solo staking your ETH. Another point that the researchers raise is the fact that the narrative for Bitcoin to TradFi was pretty straightforward. It's digital gold, and it could help to diversify risk-off hedges like normal gold. However, given that ETH is an asset used for a protocol, the pitch is less compelling, which is a good point for sure, and it's one we talked about in much greater detail in our most recent Ethereum update, and that's up there in the right for you guys. One more thing that they mention is the fact that the lower liquidity of ETH compared to Bitcoin makes it less desirable to hedge and quant funds. As a result of this, JPM estimates that we could only expect to see between $1 to $3 billion worth of inflows into these ETH ETFs over the rest of the year. When you consider that that's about 6 to 18% of the inflows that we have seen with Bitcoin, it's really not that significant. And even if we were to account for Ethereum's lower market cap, which is about 32% of Bitcoin's, it's still about half of the market cap weighted inflows to make it on par with Bitcoin inflows. And that's just JP Morgan though. The Bloomberg ETF analysts also gave their rough estimates of the potential inflows to these products after the initial approvals came through in May. Eric Balkunas said that he expected about 10 to 15% of the Bitcoin ETF inflows. This is about $1.5 to $2.4 billion, which is slap bang right in the middle there of the JP Morgan range. He also used the same rationale as them about demand being hoovered up by Bitcoin, albeit with an analogy of Sister Hazel playing after Nirvana at a concert. And I actually had to Google who the hell Sister Hazel are. And what I will say is, damn, Eric, you're cold, bro. Like, what did ETH ever do to you? Anyways, if you guys are enjoying this video, help out by giving it a boost with a like. You may also want to subscribe and ping the bell as well to make sure that you don't miss the next one. Anyways, back to ETH. Now, there is one more wild card out there that could surprise to the downside, the $10 billion elephant in the room. And that's the Grayscale ETHE trust. This will also be converted to an ETF. And if you will recall, Grayscale's Bitcoin product was the cause of a great deal of selling pressure after its conversion. Quite simply, investors had been arbitraging the Grayscale discount and had been banking the profit once the discount finally closed. Of course, there was another factor, and that was the fact that GBTC was considerably more expensive than all the other ETFs. And it seems as if Grayscale is going to make that same mistake again with fees on their Ethereum ETFs that will be at least 10 times those of their competitors. And what's even worse is the fact that many of their competitors have fee waivers for at least a year. That means that Grayscale ETH holders can choose between paying 2.5% on the one hand or getting it free on the other. Which one would you guys choose? It's a really concerning point. GBTC lost over 50% of its assets under management in just 6 months. If the same were to happen with the Ethereum products, that's about $5 billion. This could completely counteract any buying pressure that comes from those ETF buyers. And if the outflows are toward the downside estimates of JP Morgan and Eric, then that means that the ETH Trust outflows could be net negative for the market, i.e. only outflows. It's a scary thought. Okay, so that's the bear case. However, more recently, there have been a number of bullish estimates and analysis. Let's take a look, shall we? Firstly, we have this report that was drawn up by the folks over at K33 Research. They are a top-notch research firm, and the Coin Bureau Club subscribers get a 50% discount on their subscriptions.
What's the Coin Bureau Club?
What's the Coin Bureau Club, you ask? Well, I mean, it's our exclusive altcoin insider community. Hidden reviews, research, members Discord, product discounts, and much more. Check out that link in the description. Anyways, back to K33. Their report from early June tried to get a sense of the potential demand by benchmarking ETH to BTC and projecting out based on Bitcoin ETF flows. And when it comes to the particular benchmarks they use, they look at the ratios of ETH to BTC for US futures-based ETFs, global ETPs, and CME open interest, excluding the open interest from the ETH futures ETFs, of course. In simple terms, they are trying to get an idea of the relative institutional demand for Ethereum compared to Bitcoin. You can see these ratios right over here. This produces a range of different estimates of relative demand. These ratios are then applied to the amount of funds that had flowed into Bitcoin ETFs at the time, which was about 13.8 billion in their first 5 months. When they apply these ratios to those flows, they get the following estimates of the first 5 months of inflows. They think that it's more appropriate to look at the CME futures ratios and the global ETP ratios than the futures ETF ratios, something I tend to agree with. And that's just because the Bitcoin futures ETFs launched at the peak of the 2021 bull market, whereas the ETH futures ETFs launched in the doldrums of the 2023 bear market. Anyways, looking at CME futures and global ETP ratios, the inflows range from 3.1 billion to 4.8 billion in 5 months. So let's assume that these are the net inflows. Then the question is whether this would translate into any movement in price. Well, Economics 101 would dictate that limited supply with an additional demand should lead to an increase in price. Over here, K33 has a regression analysis of the movement of Bitcoin's price compared to the ETF inflows. The R-squared, which is a statistical measure that measures the relationship between two different variables, is 83%, which is quite statistically significant, i.e., there is a strong positive relationship between inflows and price. So, if the same relationship holds, it could have a positive impact on ETH's price. Anyways, on this page over here, they cover the staking opportunity cost point that we mentioned earlier. However, they take a look at the experience of non-staking and staked ETPs in Europe and Canada. Quite simply, investment flows are sticky. Even though staked versions were introduced in Europe and Canada, 99.1% and 97.9% of the AUM in Canadian and European ETPs, respectively, are non-staked. Investors just don't seem to care at all about whether they are staked or not. Okay, so that's K33's analysis. But another research report that came out recently was that from the folks over at Galaxy Digital. If you will recall, they came out with a similar report last year before the Bitcoin ETFs were launched, and it underestimated the inflows. I broke down this Ethereum inflows report in a tweet thread over here, and we'll leave a link to it below so you can come back and read later. But right now, we'll go through it with you guys in detail. Firstly, as was the case with K33, they tried to get a sense of demand based on CME futures open interest and ETF fund AUM. On average, across both of these categories, they get a ratio of 31% institutional demand for ETH relative to Bitcoin. If they apply this ratio to the annualized Bitcoin flows, they estimate that we could see $1 billion worth of monthly inflows, which is about $5 billion for the rest of the year. This is pretty consistent with the K33 estimates, albeit to the higher end of the range, but it's good to have confirmation of that. However, what's perhaps the most interesting part of the report is what they think could be upside surprises to the inflows and price action. One of these is the fact that the potential Grayscale outflows could be FUD and may be way less than those seen for GBTC. And that's because of two factors. One is that there is less in Grayscale's ETH product relative to our stand-in supply than there was for GBTC relative to Bitcoin supply. The second is that, unlike with GBTC, there aren't many forced bankrupt sellers out there. Remember that both Genesis and Three Arrows Capital had large holdings of GBTC and were hence forced to liquidate. Based on these two factors, they have estimates for the outflows from Grayscale's ETH product of only about $36 million per day on average, compared to Bitcoin's $130 million a day. So perhaps the market is being a bit too pessimistic about these outflows. But there is another potential upside surprise here, and that's hedge funds engaged in a futures cash and carry trade. For those unaware, this is a well-established strategy of going short futures and then going long the underlying spot asset, thereby earning the carry. If you will recall, this seems to have been one of the main drivers behind lots of the institutional inflows into Bitcoin ETFs. However, it's likely to be more pronounced for Ethereum, and that's because ETH futures funding fees are higher than those of Bitcoin's, i.e., a cash and carry trade with ETH should yield higher returns and hence be more attractive. But perhaps the most interesting part of the Galaxy report is their analysis of the price sensitivity of ETH relative to Bitcoin. As mentioned earlier, price is driven by the impact of the demand and supply equation. If there is less available supply for ETH relative to what there was for BTC, then it means that it could be more sensitive to ETFs buying. In this case, ETH inflation rates are lower than BTC's. Remember, up until a few months ago, it was also negative, i.e. there was deflation. In this chart over here, they show that ETH inflation rates are at least half of those of BTC. On top of that, there is also less ETH that is held on exchanges, which also impacts on the available supply to be bought by the ETF issuers. But those aren't the only supply factors that we need to consider here. Remember that there is a hell of a lot of ETH that is locked in state supply, smart contracts, bridges, etc., and not to mention the dormant and lost ETH. Therefore, holding all else equal, there is less adjusted ETH supply than there was with BTC, and it should technically have a greater impact on price. Add in the potential impact of lower than expected grayscale outflows, and it could send ETH to Valhalla. Theoretically, of course. But just remember, theoretical fundamentals often go out the window when it comes to crypto investing. So, where are we headed? And what do we here at the Coin Bureau think? Well, it is true that a lot of the demand from investors was taken up by Bitcoin ETFs. Many TradFi investors are still getting used to the idea of investing in a digital asset and expecting them to YOLO into another crypto asset just like that. It's wishful thinking. Not only that, but the investment pitch for ETH isn't as solid. It lacks that 10-second elevator pitch that retail can easily relate to. It's also true that the overhang of the Grayscale trust could lead to outflows. However, we happen to think that the impact of this could be overstated. Although the fees are exorbitant, if investors do choose other ETFs, the impact on the net flows is likely to be null, i.e. out of the one pocket and into the next. Moreover, there are no forced sellers here. There's no 3AC or Genesis GTing their ETH bags on the market. We also think that the motivation behind the ETF cash and carry trade is likely to be more pronounced for these ETFs. The result is more demand relative to Bitcoin. Add to that the impact of the lower supply, and it's easy to see how ETH could rally much more than Bitcoin did out of its ETF launch. If the ETF flows that K33 and Galaxy estimate are to materialize, 4 to 5 billion, then it's easy to see ETH rallying by at least the same amount Bitcoin did, which was 40% over 5 months. And that would, of course, take ETH close to its previous all-time highs. If we were to throw in the added impacts of the sensitivity to inflows, it's easy to see why analysts are predicting a 5K ETH in a couple of months. For example, we have Matt Hogan of Bitwise Asset Management, which is, of course, one of the issuers, who thinks that we are likely to see a 5K ETH by the end of the year. There are even more bullish estimates out there. QPC Capital, a Singapore-based investment firm, touted a potential 60% rally, taking ETH well above 6K in the coming months. Wes Levitt of Transform Holdings has a similar 6K price prediction. Then, of course, who can forget the perma-bulls over at Standard Chartered? They have an end-of-the-year ETH price prediction of $8,000, as well as an end-of-next-year price prediction of, get this, $14,000. Lots of hopium smoking going over on there at Standard Chartered HQ, it seems. But I do love their optimism. Jokes aside, there is more on the horizon which could add wins to ETH's sales. If broader market conditions do turn, say a Fed pivot, coupled with a Trump victory, say pro-crypto regulations, it could be a massive boon which could boost ETH to the moon. And it couldn't come a moment too soon. And that's it for our video today. But please, I would love some of your feedback. So tell me, what impact do you think the ETFs will have? A damp squib or rocket fuel? And if the latter, what are your personal price predictions? Let me know down below. And while you're tapping away at that comment, why don't you tap that like button? If you want more, don't forget to subscribe, and it would be swell as well if you hit that bell as well. Much more coming your way. Thank you very much for watching. Nick, over and out.